Hey guys, welcome to this lesson whereby we'll be doing an example of the company's ledger accounts. So I wanted to make this video as engaging as possible. So it's special because you can see my face on the top left corner and you'll see me working through this question. So you'll be able to see my thinking process. I'm going to make a few errors there and there and I'll come back to fix them. That's what will make this video engaging as possible. So we're just going to read through this example, and then they say you must prepare the ordinary share capital, retains, earnings. So these are all the ledger accounts we spoke about previously. Now we're going to be applying that knowledge in preparing these T accounts. So let's read this example. So they say use the following information to complete the following ledger accounts given for Genius App Limited for the financial year ended 30 June 2022. So now you already know that your financial year ends 30 June 2023, meaning that it started on the 1st of July 2022. So your financial year starts on the 1st of the following month on which it ends in this current financial year. So it started on the 1st of July 2022, ends on the 30th of June 2023. And if you count the months here, you'll get 12 months. So they say you must prepare the ordinary share capital account, retained earnings account, SARS income tax, shareholders for dividends, income tax, ordinary share dividends, and the appropriation account. So on the left hand side, that's when you'll see the questions and the additional information. And on the right hand side, that's where I'll be working out the answers. So this is Excel. I'll be working out my answers on Excel. Please make sure that you follow and you listen carefully at what I'm saying so that you can be able to follow these calculations. So let's start with the first additional information. So they say on the 1st of July 2022, which is the beginning of the financial year. And then they say at the beginning of the year, the company had the following opening balances. In terms of ordinary share capital, they had 500 shares which were in issue and the value of the shares was 1 million rand. Remember we said the ordinary share capital account is an equity account, meaning that it increases on the credit side, meaning that the balance of the ordinary share capital will always be on the credit side. So the balance, the opening balance, so we call it the balance brought down, which is on the 1st of July in 2022. So on the 1st of July 2022, we had balance brought down of 1 million. So this is the balance brought down. This is an equity account. It increases on the credit side. Therefore, its balance brought down will always be on the credit side. And then they say you have a balance of retained income of 180. Retained income is also an equity account. It increases on the credit side, meaning that the balance brought down of retained earnings will be on the credit side. If you want to check. So this is the balance brought down on 1st of July 2022. Right, and then SARS income tax had a balance of 9,000, which was a credit. So with SARS income tax, most of the times they'll tell you that the opening balance is either a credit or a debit. So the SARS income tax can either have a credit balance or a debit balance. What does it mean? When you have a credit balance, it means that SARS owes you money. Remember we said this account is a liability account, meaning that liabilities increase on the credit side. Meaning that when you have this balance on the credit side, it means that you owe SARS money instead. You owe SARS money, right? Because you have a liability. Sorry about that. So it's a liability account. It increases on the credit side. So if you have the balance on the credit side, it means that you owe SARS money. But if you have a debit balance, it means that SARS owes you money, right? If you have a debit balance, SARS owes you money. So in this case, we have a credit balance of 9,000, meaning that we owe SARS 9,000. We still have to pay SARS 9,000. So this is the balance brought down on the 1st of July 2022. And then shareholders for dividends had a balance of 130,000. So shareholders for dividends, as discussed above, is a liability account, meaning that we owe shareholders money. We owe dividends to shareholders. We still need to pay them. And this liability account increases on the credit side according to the early method. Remember the early method. Let me just write it here so that we can also use it. We have the early. Okay, I don't know what's happening, but we have. Let me just erase. This. Let me just go a bit up and say we have early. So we have the early method. So it increases assets, they increase on the debit side, and liability increases on the credit side, income on the credit side. So this is credit and this one is debit. So this one is credit, this one is debit, debit, and then we have credit. So assets, they increase on the debit side, decrease on the credit side. Liabilities increase on the credit side, decrease on the debit side. Income increases on the credit side, decreases on the debit side. Expenses increase on the debit side and decrease on the credit side. So since we said shareholders for dividends is a liability account, meaning that we owe shareholders money, the balance will always be a credit because we owe shareholders money, meaning that our liability is high, 120. So this is the balance brought down, and it's brought down on which date? The 1st of July 2022. Right? So we're done with our opening balances. We're done with our thinking process of our opening balances. Let's go to a transaction on the 1st of July 2022. So they say the company issued 50,000 shares to the public at R7.50 per share. So the company issued 50,000 shares to the public, right? Meaning that there are people in public who bought the shares. And when they buy the shares, that means the company is receiving money. One of the accounts affected is bank, which is an asset. It's increasing on the debit side because the company is increasing money. The second account affected is the ordinary share capital. Remember, I said when shareholders buy shares in the company, their wealth in the company increases, and this wealth is equity, and it's contained in ordinary share capital. When the ordinary share capital account increases, it shows an increase in the owner's wealth in the company, and it increases on the credit side. So when the company issues shares, the ordinary share capital increases on the credit side. It is credited. So we're going to credit ordinary share capital on the 1st of July 2022, and then we're going to say bank, because when we issue out these shares, we're receiving cash from the shareholders. And then I'm gonna skip this column, and I'm gonna say, so the amount they invested in the company, which shareholders invested through buying shares, is 750 per share times the 50,000 shares. So in total, the shareholders injected this much money in the company, which is 50,000 times 750. Let's go to the second transaction. On the 23rd of July 2023, paid the amount owing to SARS and shareholders. So the company paid amounts owing to SARS and shareholders, meaning that their liabilities, the money owed to SARS and shareholders, is decreasing. Remember, at the beginning, we were owing SARS 9,000 rand. So the company paid this account, and when they pay, this liability will decrease on the debit side, according to our early. So we're gonna decrease this liability by 9,000, And when we're paying an amount, obviously bank is affected, and this happens on the 23rd of July 2022. And we have shareholders for dividends because they also said they paid the amount owing to shareholders. Therefore, this liability is also going to decrease on the debit side. And we're going to have bank because we're paying money. And this is on the 23rd of July 2022. Right? And let's go to the next transaction. So they say a first provisional tax payment of 112,500 was made to SARS halfway through the financial year. So when the business makes a payment to SARS, it decreases the liability we have on the debit side. Remember, the liability decreases on the debit side. So the SARS income tax will decrease by 112,500 and made a payment. So bank is affected on which date? On the 31st of December 2022. But someone may be asking, but Blessing, at this point we don't owe any money to SARS because we paid the 9,000 we were owing at the beginning. So why are we paying a liability we don't have? So what happens is a company usually makes payments to SARS in advance through provisional payments. So they pay amounts to SARS, and then when SARS charges income tax and say, okay, this is the amount you're supposed to pay, they're gonna plug it on the credit side, increasing that liability. But those payments will have already covered part or all of that amount. So whenever they make a provisional payment, we go and debit SARS income tax because we're decreasing this liability, even though we haven't finalized the amount, because we can only finalize this amount at the end of the financial year when we know how much profits we've made, and we times that by the income tax rate. So when we do that, we'll plug that amount on the credit side. But for now, the business will make provisional payments, and these provisional payments will go to the debit side of the SARS income tax. So provisional payments, they go to the debit side of the SARS income tax because we're decreasing this future income tax liability, even though we haven't recorded it yet. I hope that makes sense. And then on the 31st, they say an interim dividend of 15 cents per share was paid to shareholders. So the company paid a dividend of 50 cents per share. So in this case, this dividend was paid, meaning that we don't owe shareholders anything, right? We paid this dividend in cash. So it's gonna affect our ordinary share dividends. Remember, I said whenever a company declares a dividend, the ordinary share dividends account is debited, is the debit account. So we're gonna debit this account by, we have that 15 cents times the number of shares that were in issue in that date. So in this date, the number of shares that were in issue is this 500,000 shares at the beginning, plus this 550,000 shares we issued on the 1st of July 2022. So on this day, the company will pay a dividend of 15% per share on this 550 shares. So we're going to multiply the 15 cent by 550, 1, 2, 3, and then we debit that by bank because we've paid this amount, right? It's not a liability because we've paid this amount. So shareholders for dividends won't be affected because we declared and paid this dividend on the same day, right? And then we go to the transaction on the 31st of March 2023. They say the company bought back 20,000 shares from a disgruntled shareholders. The directors decided to buy back these shares at 8 Rand per share. So the company can buy back shares from shareholders, and when they do this, this decreases the ordinary share capital because the equity that shareholders have in the company is decreasing, because when they buy back shares, those shareholders no longer have equity in the company. Therefore, this ordinary share capital account will decrease. And here's a tip here. The ordinary share account doesn't decrease by the full buyback amount of 850. We only decrease the ordinary share capital by the average share price on that date. How do we get the average share price? So what you do to get the average share price is you'll take your total cost or total value of your share at a certain date. So you take this 1 million. Is it 1 million? Yeah, you take this 1 million and then you add the 375,000. So this is the total value of the shares on the date. So the total value of the 550,000 shares. So you take the total value of the shares on the date of buyback, you divide it by the number of shares, and then you get the average share price or the average price per share, which is 250. So let's walk through that again. So to calculate the average price per share, which you're going to decrease the ordinary share capital account with, what you do is you take the opening balance value, you add any share issues, a value of any share issue during the year before the buyback, and then you divide it by the total number of shares in issue at the date of buyback. And when you do that, you get the 250, which is your average share price per share, right? And that means your account here, you're going to decrease it by 250 times the number of shares the company bought back, which is 2123, right? So this decreases by this account. So the account affected is bank because we're paying out money. So this is on the 30th. No, this is on the 31st of March 2023. So now you may be asking yourself, okay, Blessing, if we only decrease the ordinary share capital with the average share price, which is found by adding the value of the opening balance plus the value of any shares issued during the year and dividing by the number of shares in issue at the buyback date, what about the remaining balance, right? From 250 to 850, which is, let's just calculate it here. So if we take 8 rand 50 and we subtract this 250, we'll get 6 rand. So there's a 6 rand difference there. Where does this 6 rand go? So this 6 rand is taken from the retained earnings. Remember I said the one way that retained earnings will ever decrease is through share buybacks. So what you do is you find the average price per share and then you use it to decrease the ordinary share capital. And then the remaining balance is taken from retained earnings. So you have 20.53. So retained earnings is going to decrease by 120, which is the 6 rand, the difference between 8 rand 50 and the average share price per share of 250 on the buyback date. So that 6 rand is going to be multiplied by 20,000 to get the amount at which we're going to decrease the retained earnings at. And this goes through bank because it's part of the amount we paid. Perfect. Hope you understand that. And then on the 30th June 2023, they say a second provisional tax payment of 120 was made to SARS at the end of the financial year. Brilliant, meaning that our SARS income tax is decreasing because we made a provisional payment to SARS to cover this future liability we're going to have. So this liability is going to decrease by 120,000, and we paid because they say we made a payment, and this is on the 30th of June 2023, right? And then on the 30th of June 2023 again, they say a final dividend of 30 cents. So a final dividend of 30 cents per share were declared at the annual general meeting, but not yet been paid to the shareholders. So the company declared this dividend but did not pay the amount to shareholders on the same day. What's that? It's a liability, meaning that we owe shareholders money. How much do we owe shareholders? So let's go. So this liability will be increasing on the credit side. Since we declared 30 cents, we're going to say 0.3 and then times by the number of shares in issue at this date, which is still that so the number of shares in issue will be at 550, 123, which was this 500,000 shares in issue at the beginning plus this 50,000, but we have to subtract that those 20,000 shares which the company bought back. So the number of shares in issue at the end of this financial year, which will receive this 30 cent dividends, is 530 if you take this 550,000 minus the 20,000. So a dividends of 159,000 was declared. And when this dividends was declared, it wasn't paid on the same day. Therefore, the shareholders for dividends, which is a liability account, increases because we now owe shareholders money, and the liability, according to Ali, increases on the credit side. So it's going to increase on the credit side, and the account we're going to debit, remember, it's ordinary share capital. So the account we're going to debit is ordinary share capital. So this is on the 30th of June 2023, right? The account debited its ordinary share dividends. So it's gonna be debited by 159,000. So this is from the shareholders for dividends. So you see the difference. The account debited every time we declare dividends is ordinary share dividends, but it differs in terms of did we pay this dividends cash or not. If you pay them on the same day, you take it through bank because money is decreasing. But if we declare it, but we do not pay it the same day, we have a liability to pay the shareholders. Therefore, we take it through shareholders for dividends. We create shareholders for dividends because we owe shareholders money, and then we debit ordinary share dividend. This is on the 30th of June 2020. And then let's go to the next question. So they say after the completion of the audit, the income tax figure for the year was determined to be 240. So now SARS comes to us, or after we've calculated the profit, we can multiply the profit by the income tax rate. And when we do that, we find that, okay, this is the amount we're supposed to pay to SARS this year, meaning that our income tax expense is increasing, right? Our income tax expense is increasing. Remember, we said income tax account is the expense account, and expenses they increase on the debit side, meaning that we're going to increase this account by 240,000, right? And it's gonna be taken through, let me just write the date, this on the 30th of June 2023, and it's gonna be taken through SARS income tax account, which is a liability account, because we said when SARS charges us income tax, or when we determine the tax payable this year, we take it to SARS income tax, increasing our liability. So our liability is gonna increase by this 240,000. This is from income tax. So this is the income tax payable for the financial year ended 30 June 2023. But because companies are smart, they've already paid provisional payments, which will in turn decrease this amount, right? These provisional payments were to cover this amount. Now we don't have too much burden to worry how we're going to pay SARS or something like that, because we've already paid provisional payments that will decrease, that will make this amount lower. And they say this was calculated on net profit figure of 800,000. This net profit is always taken to the appropriation account. The appropriation account, remember, that is where we're going to distribute this profit to income tax, dividends, and the balance is going to retained earnings. So we have profit for the year. So let's say this is from profit or loss account, right? It's from profit or loss. So we're going to distribute this profit to income tax, dividends, and lastly the retained earnings. So we just plug in that profit for the year. Let me just write the date, June 2023, and then go up. So they say show the closing transfers to the final accounts. So now we've probably we're done recording all of our journal entries for the year. Now we just need to close off these accounts. So we start with the ordinary share capital. We say, okay, let's close off this account. Which side between the two is bigger, right? Which side between the two is bigger? So between the two, this side will be bigger, and then it's gonna, let me just, so I'm adding up, I'm summing all these values and take the same figure, and then what I do is I take this figure, I subtract this one, and then I have this account. So this will be my balance brought carried down at the end. So this is gonna be my balance carried down on the 30th of June 2023. This is when we're closing off the account, and this balance is gonna be the opening balance or balance brought down the following year. So this is 1st of July 2023. So we're done. We closed off the ordinary share capital, or we balanced it off, and then we have retained earnings. But before we closed off retained earnings, let's just go to other accounts, because remember, balance of the profit for this year is still going to be distributed to retained earnings, or the remaining figure after taking out income tax and dividends is going to be taken to retained earnings. So let's skip retained earnings for now and go to SARS income tax. Let's close off the SARS income tax account. You can just say okay, cool, we balance it off. So this is a liability account. It's also balanced so that you have an opening balance for the next financial year. Same with ordinary share capital, because it's an equity account. So we're gonna say which side is bigger between the two. So I don't know, let me take a guess. So this is gonna 120, this is gonna be 125, and this one is gonna be, so this is 2240. I don't know which side is bigger, but I can just do this. Let me just say sum. I was trying to be smart right there and work out the things from my head, but I'm tired right now because the time is like close to 10 p.m. or past 10 p.m. and I'm tired, so I can't do the workout. So I'm like, bah. This side is bigger, meaning that we're gonna take this side for both sides, and then the balance is gonna be here. So when I take this balance and then I subtract this one, I subtract this one, and I subtract this one, I have 7,500. So this is the balance carried down at the end of the year. So I just put the date here, 30 June 2023. So just okay, cool. So this balance is the opening balance for the following year. And then we say balance brought down on the 1st of July 2023, right? And then we go to the income tax. The income tax account is an expense account, and the expense and income accounts are closed off completely, meaning that we won't have an opening balance for income tax. We're gonna close off this account to appropriation account. So when we close it off at the end of the year, we credit this account, meaning that we're gonna take everything out of this account, and this account will be left with a balance of 0. And we take this to the debit side appropriation account. So 240. This 240 goes to the debit side of the appropriation account, and this is the 30th of June 2023. And then so that's how we close off the income tax account. You credit the income tax account, debit it to appropriation account. And then let's go to ordinary share dividends. Same with ordinary share dividends. What we're going to do is we're going to close it off completely to the appropriation account. So we have so it has a balance of so we have this balance, and we're gonna take this balance and close it off completely to the appropriation account. So when we do this, we're closing this balance off completely and we're taking it to appropriation account. So it's gonna be left with a balance of 0. And then appropriation account, we go and take this amount to this amount, and then this is from ordinary share dividends, and this is from the 30th of June 2023, right? And we go down, we have shareholders for dividends. So shareholders for dividends is a liability account, not an income, not an expense account, but a liability account, because it refers to the money we owe to shareholders. So this liability account will have a closing and opening balance. So we're just gonna see which side is bigger between the two. So it seems like this side will obviously be bigger, so we can just add everything up this side and say bar. Then the balance after taking this one, subtracting this one, will be the balance carried down at the end with, let's see, 23, and there will also be the opening balance the following month on the 1st of July 2023. So this is the balance brought down. Yes, and then let's go to, so now all we've been doing is processing closing entries, right? Closing transfers. So income expense account, they closed off completely, and the income tax and dividends account is closed off to appropriation account. So the appropriation account is like a distribution account. So we have profits for the year, and profits for the year are distributed between income tax and the ordinary share dividends. So we take profits for the year, we subtract the income tax, we subtract the dividends for the year, and if we do that, subtract income tax, subtract dividends for the year, the balance is taken to retained earnings. So this one is the 30th of June 2023. So the retained earnings balance won't have any opening or closing balance, right? So you don't have any opening or closing balance. You just take the profit for the year. You have the profit for the year on the credit side. The debit side, you have your income tax, because you closed off that income tax expense account to appropriation, so you'll have it on the debit side. The ordinary share dividends, because you closed them off to appropriation account, and the remaining balance goes to retained earnings. So this balance will be taken to the credit side of retained earnings. It increases retained earnings because we have profits which we haven't distributed, in that the equity of shareholders is increasing. Cool, let me just plug in that figure. That figure is 318,500. So I plugged it in the retained earnings account, and it's from appropriation account. This is on the 30th of June 2023. So we have the undistributed profits at the end of the year sitting in retained earnings. Now we can balance this retained earnings account because it must also have a closing and opening balance. So we just sum. So this one is going to be the bigger side. Then just sum it, and also sum this one, and I'll take this one, subtract this one, and this is the closing balance. So balance carried down at the end of the financial year. This is June 2023. June 2023, and we also have the opening balance down for the next financial year, the 1st of July 2023. So we're basically done with all our journal entries. At the end, all the journal entries will look like this. So you can wait. So this share buyback, I don't know what happened there. Let me just say okay, cool. I don't know what happened, but yeah, your things will look like this. You can just take a picture real quick and see if you can be able to find these answers on your own. So you can take a picture, but I'm also gonna save this document and then upload it under resources. Thank you for watching and hope you found this useful. Hope to see you on the next lesson. Bye.